Pierre Daly. We're at the Inside ETFs Conference in Montreal. Joining me right now is Atul Tiwari, President and CEO of Vanguard ETFs in Canada. Atul, thank you very much for joining us.
Thank you for having me.
Since you've entered the Canadian market, how have things been in terms of an American company coming into Canada?
Right, great. We've been in the market for almost 7 years now. Just a bit of history, Vanguard looked at coming into the Canadian market for over 20 years. And I'm told this was the 7th business plan to enter the market, and it was the one that finally won the day.
Right.
Vanguard as a company, as you know, has $5 trillion in assets globally, so we're a very large money manager. We don't pay anybody to distribute our product. So before the advent of ETFs, it wouldn't have really been possible to have a business in Canada, and therefore that is what compelled Vanguard to enter. That said, now fast forward 7 years.
So what you're saying is that it was too difficult for Vanguard to enter the Canadian market as a mutual fund company?
Correct. Right. Yeah. As you know, probably 90% of the mutual funds in Canada right now even are distributed through some sort of intermediary.
Right.
There's a small direct business, but it's small. So absolutely. Having said that, ETFs are great because we don't have to pay to have them distributed.
Right.
When we entered the market in 2011, fees were lower than mutual funds, but still what we thought were reasonably high. So we came in with some cost competition, and we feel pretty good about where we are in our costs, and we feel good about having influenced the market as well, which is called the Vanguard effect.
Yeah.
Other competitors have to reduce their fees to compete with Vanguard, which I think helps all Canadians. So we're feeling good about what we're doing. 7 years in, we're at about close to $30 billion in assets when you include U.S. ETFs, which are distributed into Canada to Canadians.
Of course, from advisors,
from Vanguard, exactly. So we're feeling good. There's 58 of us now in the country, and your comment about an American firm was a good one because, as you know, Canada's had a little bit of a history of U.S. firms coming in, leaving the market, maybe coming back again, leaving the market,
coming in, pulling
exactly. But that's the great thing about Vanguard, which is, again, it took 20 years to make the decision to enter Canada, and the way Vanguard works is prudent and deliberate. And once a decision is made, it's fully behind it. Therefore, our growth in crew members or employees, and it's a solid commitment to the market.
I'm just imagining that in the beginning there must have been some pushback, especially with respect to the Vanguard effect in terms of compensation. And then today, of course, there's more about compensation coming in terms of embedded commissions and DSCs and things like that have been the bread and butter for a lot of advisors for a long time. So that's quite a controversial move on the part of regulators. When you first came to Canada, did you experience sort of the reaction or the fear from the industry that with your arrival that you would bring the effect of lowering costs?
Yeah, I guess there's two parts to that question, Pierre. I'll take the cost one first and maybe the regulatory one second.
Yeah.
So the cost one, again, in the ETF space, when we started, our average MER was somewhere around 27 basis points. Now it's 15, so we pretty much halved it over 7 years from a pretty low base to begin with. I would say in terms of was there fear, it was probably, I don't know if there was fear amongst other providers, but that's really where the competition is, right? It's the price of the ETF. So from advisors, no, we didn't get any pushback whatsoever.
It sort of forced advisors to reconsider the way they get compensated.
Right. Yeah.
For a long time, right?
Sure. I mean, one of the trends that we see in most of the markets that we operate, whether it's as a result of regulation or competition, has been the move to fee-based by advisors. And that's something that Vanguard supports because we believe that it provides the greatest fee transparency for investors.
Right.
And it happens to actually then work well with our model of a low-cost investment product. because the advisor can charge a fee at the account level,
Right.
and then because they're charging a fee here, essentially they're incented to use the lowest cost product in their portfolio to get the best returns for the client. So we feel like it's a win-win-win.
This is the so-called advisor alpha.
That's right. Yeah. So you've obviously heard of the advisor alpha.
Right.
I mean, that is a piece that had been worked on for many years by Vanguard.
Right.
And you're right. It's a pretty simple concept in defining your value as an advisor. Right. It's don't go trying to pick stocks or chase the hottest active manager, because that's a mug's game.
Well, it's becoming quite a pernicious idea. It's a very sticky idea.
Right.
So
what we'd say is, look, focus on asset allocation, discipline, rebalancing, tax efficiency, and most importantly, behavioral coaching.
Right.
Because that's where an advisor adds a lot of value. And if you sit down with your client and talk to them about that value that you're providing, it's a great way to communicate with your client.
Kind of takes care of CRM2 very effectively.
Absolutely.
Sort of does away with it.
Right. I mean, advisors should get paid.
Yeah.
And the only question is being able to define to your client what they're paying you for.
Right. And you guys have done a great job of educating advisors on how to establish their value with their clients in terms of the difference that it makes in terms of how ETFs have changed their practice, how ETFs have changed their ability to deliver value.
Right. Yeah, and thank you for that. Our sales team spends a lot of time with advisors working through some of the components of Advisors Alpha. We also spend time with advisors who are moving a portion or all of their books from commission to fee-based, so we can help them do that transition.
What do you see as the future of ETFs?
I think the future is very bright. We talked about that in the panel this morning. When you think about the different channels, institutional, intermediary, and direct,
right,
each one of those channels is early innings for ETFs. And so when you look at the growth rates, 25, 30% CAGRs, the growth is there and there's momentum. I think a lot of people who start learning about ETFs want to use them. So as an industry, and this is a lot about what we talk about. In fact, right after this interview, we have a CETFA, which is the Canadian ETF Association board meeting.
That's right.
And we're very collegial about that. We all get together and say, what can we do to educate each one of those segments around ETFs and the benefits. And so it's a really great time to be in the industry because we all feel there's a bit of a mission.
Right.
And in terms of the future, again, I think early innings in each of those three channels, we're going to see the same growth continue for a number of years. And I'm very excited about some of the product innovation that we're seeing. And I'll speak about our own Vanguard.
Sure.
We came out with some single ticket solutions, and that's the next iteration of product. So it's not just going to be one ETF component. It's going to be, how do we put these together, one ticket solution to make investors, lives easier and advisors' lives easier.
Right.
So we came out with the asset allocation ETFs in February. So they're about 5 months old, got great reception from advisors, individual clients, as well as the press. And we're at about 500 million across those products now, so 100 million a month, which kind of, I think, proves that you can be successful with a one-ticket ETF solution, and the market's ready for that.
Yeah. So these one-ticket solutions, are they suitable for all investors, or are they suitable for a particular kind?
They're suitable for all investors.
Yeah.
Right now we have three, and so they go from 80-20 down.
Right. Different mixtures of assets, right.
And rebalanced by Vanguard's professional money managers for 22 basis points. So we see them as a very compelling. We have a balanced product, which is very compelling against some of the higher cost balanced funds out there.
Yeah.
So again, at 22 basis points, you're getting professional money management. They've been well received again by advisors and by individuals. Advisors are using them as core for some clients with some satellite active around them, or for their lower balanced accounts, they'll use it for essentially all of the amount of the lower balance client's account. Even today at the conference, a number of colleagues and friends at other companies have said they put their kids' RESP money into 100% into VGROW, which is an 80-20. You know, you put it in there when your kid's young and basically forget about it until they're ready to go to university. So it's a
great
lot of good
endorsement.
uses. Yeah, a lot of good uses.
Do you get with this one ticket solution? Is there any concern from the retail advisor that it's too simple? I mean, it sounds like a great solution, but I on the side of the advisor explaining it to their client, is there any sort of concern about the client turning around and saying, "Well, I could do that myself," or?
Well, again, I think you have to look at how advisors are using it for different portions of their client segments.
Yeah.
And again, it can form the core, and then the advisor will seek alpha opportunities around it. So it's perfect for a core satellite. And again, the other comment was simply on lower balance accounts. You know what? It's an easy solution, and the advisor can again spend some time on other issues with the client that adds value. The behavioral coaching, reassessing your objectives because you could change your asset mix. So there's plenty of ways to use them.
Atul, what is your message to advisors who are at this conference and for those who aren't?
Right. Really, the message is simply, take a look at the trends. Not just in Canada but other markets. Most of them are going towards greater fee transparency. Most of them are going to a fee-based model approach. I think regardless of whether the regulators, banned embedded commissions, which they today have said that they're not going to do, it's still something that is a trend that's organically going to keep growing.
Right.
And just think about how you want to define your value proposition to your client.
It's great to see you at the Inside ETFs Conference. Thank you very much for joining us.
Thank you, Pierre.
Thank you.